What's going on to the AMC stock family? In today's video, we are going to be talking about the $10.5 billion lost by major short sellers, the one, the only Citadel Securities. And this all relates back to GameStop and, of course, AMC. Now let's get started because we are also going to be talking about some CNBC investors. Yes, CNBC, who is usually not on our side, they're telling everyone to buy the dip, and you guys will hear exactly what they're going to say. I don't think there's any reason to panic. In fact, if they're bullish, you bet I'm bullish. So investors betting against AMC Entertainment Holdings and GameStop Corporation shares are slowly limping on recovering a small fraction of their losses following the company's share price increase this year. AMC and GameStop Corporation became the center of public tussle between retail and institutional investors. Now, this mention of institutional investors, this also includes the hedge funds. Don't forget that. With the former inflicting heavy losses on the latter after collectively purchasing the company's shares and driving the share prices to record highs. This is talking about the AMC stock movement, or in other words, us. And this led billions of dollars in losses for the institutional hedge funds, and those who bet against companies have reversed some of these, with those short-selling GameStop shares faring better than their AMC counterparts since June, indicates data from last week. Now let's take a look at this data real quick. So GameStop short sellers recover roughly $1 billion in losses since early June. What does this mean? Well, when you have the concept of short selling, your bet is victorious once your underlying equity decreases in share price. That is how those people win. However, for those of us that are participating in the AMC stock movement like you and I, we are regular buyers of underlying equity, so we are betting that stocks go up in share price rather than down. And so because GameStop and AMC have recently been declining in share price, AMC used to be at $51 a share, now it is back all the way down to $38 a share. So these institutional investors, they are recovering their selling position because before they used to be losing much more, $10.5 billion. Now they are slowly starting to get that back, roughly $1 billion in losses since the summer, early June. And so the latest data, courtesy of S3 Partners LLC, reveals that by the end of last week, short sellers who bet against AMC had lost $4.8 billion over the course of this year. The picture was bleaker for those who had targeted GameStop, with the data revealing that the short sellers' year-to-date losses stood at $6.44 billion. These are all the numbers and all the data that you need. And this also shows that AMC and GameStop short sellers have lost $10.52 billion as we exit the third quarter. Let's continue reading. However, while they are still in staggering losses, data from the start of June reveals that short sellers have recovered about 12.5% of their losses since June. And back in June, AMC short sellers had lost $4.5 billion through the year, and GameStop short sellers were in a worse position after having lost $7.5 billion during the first 6 months of the year. And the bulk of this beating came when GameStop shares soared to a record high price of $343 per share as the retail camp purchased the shares in bulk, and some hedge funds ended up going out of business. One of these may include Melvin Capital. Now, why might this include Melvin Capital? That is simply because Melvin Capital was supposedly 50% underwater in its selling position for AMC, and Citadel had to end up helping them because Citadel and Melvin Capital are partners. And additionally, the short interest shares, which stood at 90 million in June for AMC and at 10 million shares for GameStop, now stand at 86 million and 7.7 million for the duo, respectively. This highlights the fact that institutional investors betting against GameStop have been more nervous about their bets when compared to those who bet against AMC. GameStop does fluctuate in price much more than AMC, so that does actually make a lot of sense. And interestingly, however, while the AMC short interest shares have dropped since June, recent data reveals that they are rising again. This is important for the AMC stock community because this indicates that there are a lot of sellers, and this also indicates why the price is going lower. But don't worry, because we're going to be talking about, yes, even CNBC saying to buy the dip. And for instance, in late August, they stood at roughly 82 million, highlighting that by the end of last week, more than 4 million short interest shares were added to the bets against the company. This is exactly what we need. 4 million more shares against us, against the AMC stock movement, and that is undoubtedly going to create selling pressure. And right now, there isn't really a lot of demand. There aren't those buyers stepping in, but that will change very soon. And CNBC agrees as well. And this is very similar for GameStop, with the short interest shares at their highest level since August. Wow, this is absolutely insane because this used to stand at 7.21 million. However, in percentage terms, the negative sentiment against AMC appears to be stronger. Again, this is directly important to the AMC stock community. So if you guys are wondering why the AMC price is going down, make sure to share this video with your fellow AMC investors because we have actual statistical data indicating that much more bears are involved with AMC rather than bulls, and there's actually much more negative sentiment or negative feelings surrounding this stock. So there's no reason to stress, there's no reason to panic. However, this is just the environment that we're in right now. And this is underscored by the fact that AMC short interest shares have grown by roughly 10% since late August. Those for GameStop have grown by 6.7%. And the growth in AMC short interest shares is also accompanied by a small increase in the borrowing fee, which currently stands at 1.2% after the 13 basis point increase. Now, with that being said, we are now going to be talking about the CNBC investors. Make sure you guys hear what they end up saying about all this selling sentiment, because even they are supporting the statement that now is a time to buy the dip.
Josh, I guess the central question, buyable dip, Or is this now the start of that correction that we've been thinking might be coming? What do you think? Because I look at you as a seller today, and I see you selling a stock that you loved, that you made the case for multiple times on this show, that you had bought just back in April at the end, and that is Leslie's. It's a pool supplier. It's been down in the last 3 months, and you're a seller. Can you tell us why and what that says, if anything, about your big market view?
No, it has nothing to do with my big market view. Leslie's did something disgusting shortly after I started to buy it. They did 2 secondaries in a row, neither one of which was raising proceeds for the company to use. Basically, they were creating space for some of their larger shareholders to sell. I don't mind if you do that once within a few months of the IPO, but if you do 2 in a row inside of a 60-day period, basically you're gross, and I don't do business with gross people. So I'm out. I guess I got it wrong. I think I came out at something like a 20% loss. That's okay, though. I'm adding to other positions right now, and I would not interpret the sale of an individual stock as a market call. I don't make big market calls. I'm as bullish as ever. I buy every dip. I buy every correction. Okay, interesting, because Stephanie Link, Jim Cramer says it's too soon to buy this dip. That terrible day we had yesterday, he says, quote, mindless dip buying has been a great strategy for the past 15 months, but it's worthless in the face of a serious sell-off, which is what we have now. You must not agree with that, because you did buy on the dip, and you bought Caterpillar, and you bought Diamondback Energy yesterday. Can you tell us why and what you make of what Cramer says and what your move suggests that you don't agree with that?
Because I'm focused on fundamentals, I don't know how to time this market. I don't think anybody does. All I try to do is buy low and sell high. And these two stocks are down quite a bit from their highs. But let's just step back for half of a second here. September, we have all talked about, is a volatile month, and this year is no different. We have worried about Delta for a while and peak growth. Now it's China. But this against a backdrop of the economy and data that's actually coming in pretty good. Retail sales is 10% above pre-pandemic levels. Industrial production is just 2 percentage points below pre-pandemic levels. We've seen a snapback for sure. But more importantly, Scott, I listened to all the conferences that are going on. And 2 weeks ago, Vertical Research had an industrials conference. And every single one of these companies there talked about the demand is strong. It has not wavered at all. It's the supply side of things that are giving them headaches. Thankfully, many of them have pricing power. And thankfully, several of them have done restructurings. That brings me to Caterpillar. I think the demand is going to be off the charts. Ashtod just reported last night. They told you it was. They just raised their numbers. But the stock CAT is down 26% from its highs. It's a very strong U.S. infrastructure play. It's a restructuring story, so margins should hold in. It's a rising free cash flow story. They're going to generate free cash flow this year of $1 billion. They're buying back $2 billion worth of stock. It trades at 19 times a discount to the market with a 2.2 yield. So that is a good story to me. That means when the stock breaks, that's a buying opportunity. It's down 26% from its highs, as I mentioned. Diamondback, kind of same deal, right? It was down 6% alone yesterday, and it's down 20% from its high. Last week, they announced an accelerated buyback program. So they feel confident in their fundamentals. CapEx is coming down. Production is going up. They're reducing debt. So to me, I am not going to time this market well. I know it. But if I can average into really good, strong fundamental positions, which I know Jim would agree with, if you can do that and you can buy in small increments along the way, well, then I'm going to do it all day long.
Okay. Which brings me to Mr. All-In, better known as Farmer Jim, who has been bullish, arguably more so than anybody else on this program. He sees the Dow Jones Industrial Average go down 900 points yesterday. He looks at his portfolio and he says, I have to buy more. Nothing. You didn't buy anything on the dip. Cleveland Cliffs.
I'm all in. I would have to sell something,
was down
Scott.
10% yesterday. You called in and made the case as to why you love it. It's down another 4% today. I don't see you buying anything.
Hey,
what's going on, Mr. All-In? You just got a 1,000-point gift.
Yeah, I'm all in, Scott. I mean, it's the simple math of if I'm at 2% cash, I'd have to sell something to buy something. I'm not selling anything. I absolutely love my portfolio right now.
Be somebody. Step up.
That's okay, right. Josh. The sad thing is we can't see each other the way we used to be able to on the desk. I have to assume that Josh is laughing and smiling as he says that. We all know that margin is the way that people get into deep trouble. But let me continue. Absolutely nothing has changed in my outlook. Absolutely nothing. And Cleveland Cliffs down 10% yesterday. That is just the market being irrational, which it does from time to time. If it weren't irrational, all of us on this show and you, Scott, we'd have nothing to talk about, okay? Sometimes it gets irrational. If you don't own Cleveland Cliffs and you're not buying it right now, I can't help you. I can't make the case any more clearer or logical than I did yesterday. Their costs are going down. Their revenues are going up. You're going to get free cash flow sent back to you. What Stephanie just gave us 2 minutes ago as far as the economic backdrop was perfect. No surprise that I love what she said. The economy is actually quite strong. We're going to go through a massive inventory restocking. And companies like Cleveland Cliffs or Marathon Petroleum or GM, these are the companies that are going to be providing the goods and services that are needed to build those semiconductor plants in Arizona. Union Pacific is going to be needed to transport goods across the country, including all of those containers sitting off the port of Los Angeles and Long Beach. I mean, you just have to look forward past 2 weeks, which if you're a long-term investor, you can do. But the market will be irrational.
I think Josh Brown said...
Let me make this very clear.
Okay, go ahead.
I'm all in, Scott, not wavering for 1 second.